This is the Asia Trade. I'm Shery in Tokyo. The top stories this hour. Oil climbs on reports of an Iranian attack in the Strait of Hormuz. Local media say Tehran will bar U.S. and Israeli ships from the waterway under a proposed deal with Oman. Asian stocks set for a mixed open after U.S. equities fell ahead of Friday's jobs report. Memory firms in focus after forecasts from U.S. peers underwhelm. And we'll be watching SoftBank after it reported a smaller than expected decline in quarterly net income, thanks in part to Intel.
I'm Haidi, Stroud-Watts here in Sydney. Take a look at the setup for trading across Asia this final trading day of the week. We are looking like quite a bit of volatility to the downside with this sort of re-escalation of some of these geopolitical tensions, sending equities, bonds lower in the overnight session. Oil, of course, also jumping. We'll get to that in just a moment. But we see US last trade a little bit weaker there as we finished off the session. We see Korea potentially seeing a little bit of upside. There were multiple reports that we saw sort of resilient demand for memory still. That pricing aspect will continue to weigh, but looking like we'll see an interesting session from Japan, given that from the start of the US equity session there was that renewed weakness in the yen. It's just been a week since we had that bout of yen intervention, but that sort of renewed failure to drive the yen beyond that 155 level is really weighing when it comes to how credible and how long lasting these intervention impacts will be. So dollar yen at the moment sitting at that 158 level. Switch out the boards to take a look at really the geopolitics play. Of course, oil continuing to extend these gains now on these reports that Iran attacked hostile targets in the Strait of Hormuz. This sort of sidestep when it comes to the deal with Oman is also weighing quite heavily on the oil trade there, with Tehran seeking to buy US ships from Hormuz in that deal with Oman, also banning Israeli ships from passage there as well. Australia looking a little bit softer as we head into Friday morning trade. Well, Iranian media says that Tehran has struck these so-called hostile targets in the Strait of Hormuz. It comes amid these reports that there will also be the barring of US and Israeli vessels from the waterway under this proposed agreement that we've been talking about between Tehran and Oman. President Trump had insisted that the US is in control of the strait.
I don't want to say it has been. It's sort of open right now. You know, we have a thing called the blockade headed up by the US Navy, and we control it. And now we control it, but they can always shoot something. They always have something or drop a mine. I think we're doing very well. I'm involved in the negotiation. I think we're doing fine. It could be soon.
Bloomberg editor Michael Heath joins us now. We're just saying a little bit earlier, you thought it sounded a little bit too easy that we were on the home stretch.
Yeah, I mean, just the way they were discussing this agreement between Iran and Oman, it did just sound quite reasonable about how it would work. Iran would obviously have some oversight, but ships coming in through the Iranian side, out through the Omani side, and European countries coming in to do some demining, etc. It all sounded fairly straightforward, and it seems that that's not the case, based at least on these Iranian reports. It looks like they want a lot more control. So in addition to barring US and Israeli ships, they also they'd want compensation for what they describe as hostile countries. Now that's a pretty wide-ranging tag that they can sort of apply to anyone they want to, and also they would want some sort of funding for environmental and insurance costs and this sort of thing, which again sort of signals tolls. So it's very hard to see how this would be acceptable in Washington. The other point to this, though, is that there is what you hear publicly and in the local media, and what's actually going on in the negotiations too, which may well differ, but it certainly doesn't end the week on a particularly happy note.
And I guess the sort of point is also this was supposed to be, I guess, the easiest part, right? The commercial part of a deal before you even get to issues like proxy fronts that have been opened up, issues like obviously the nuclear disagreements as well.
Yeah, and look, we saw this widening that's becoming really worrying with the Houthis attacking the Saudi-backed government. There's quite a lot of bloodshed and fighting that's been going on there, and again that raises the question of threats to the Red Sea and that sort of thing on the Saudi side, and as you mentioned, the nuclear agreement, and we're so far from even getting to that point, which was supposed to be central to the initial attack. So yeah, the whole thing seems to have blown off course, but even these sort of greatest fears about a widening conflict, that they don't seem to be, they seem to be a possibility at the moment as well. So yeah, really a bit disheartening at the moment.
And we keep continuing seeing reports of U.S. missile air defense shortages as well. How does that really up the risk of that threat to U.S. deterrence at this point?
Yeah, Shery. I mean, there's been a few reports. There was one in the Washington Post that's saying that that President Trump, on the sidelines of a cabinet meeting, had let fly at Defence Secretary Pete Hegseth about that. And the administration has sort of been playing this down, but it does seem to have some legs based on that, and also the fact that while the US keeps threatening that it will renew, very significant attacks, President Trump had some very strong statements over the weekend. That hasn't come to pass, and there's been cases of Iranian officials starting to even mock this, that it's sort of this loop of theatre kind of thing. But it may well be that they just don't want to dispense with these weapons. I mean, use what they've got left, and just to change it up a little bit. In Ukraine, they're saying they've got no air defence now, basically from Russian missiles, presumably because the US can't provide them now either. So yeah, that is another factor in there about just how credible the US stick is in this situation now as well.
It plays into the picture of course, President Trump's administration has traditionally positioned as being quite isolationist, but at the moment you've got essentially conflicts on three fronts that are unresolved, and at least a couple of them look like they're not going to be resolved anytime soon. Yeah,
I mean, look, you can't really blame him for what happened with with Israel in the Middle East and with Russia and Ukraine as well. They weren't his wars, but certainly this one. I mean, this is as big, if not bigger, than the second George Bush got into. So. Yeah, I mean, which President Trump had been very critical of. So it really is. It is a little bit of a hornet's nest there, and there's a reason that people have sort of tried to avoid it for a long time. But yes, I mean, this has turned out to be quite an interventionist administration, which is the exact opposite, I think, of what people were expecting when the second Trump administration was elected.
Bloomberg editor Michael Heath with the latest on the US-Iran war, and we'll continue to watch for whether we might see that further re-escalation from Washington as well. But take a look at the reaction across markets overnight. Of course, it was not a great session when it comes to US stocks, and it is this situation where we are starting to get investors again paying attention to the geopolitical uncertainty, given that at one point we almost saw the reopening of the Strait of Hormuz kind of baked into that optimism there. Nikkei futures looking pretty flat at the moment. The Kospi looking like we'll see a bit of outperformance. Sydney stocks, after hitting that record high this week, we might see more of a pullback picture today. Let's bring our Bloomberg equity strategist, Sunny Banjir, who joins us here in Sydney. Really good to have you with us. Where are we at in terms of sentiment, right? Because if you take a look at, I was looking at the sort of crunch between how cheap potentially US stocks are actually looking at if you compare to, very lofty projected earnings expectations. Is that what's weighing, or is it sort of the broader fears over AI as well as now this overlay of potentially a prolonged energy crisis?
Yeah, absolutely. I think there are elements of what's happening in the Middle East that are keeping investors a little bit nervous, because the long end of the US Treasury curve is pushing at multi-year highs. The mortgage rates are breaking out to all-time highs as well, so it's obviously acting as a dampener for potentially the consumer in the US. And against that, you've had a situation where situational awareness had a big blow up in the markets last month, but obviously that took a lot of that brought forward a lot of concerns about the AI spend, whether there's a bubble there, whether debt is now being fueled by debt, and on the backdrop of all that, you've got the Japanese yen also causing nervousness in markets. So I think there's a few of these elements that are coming together that are keeping investors a little bit cautious, but at the same time, you are seeing very strong earnings out of many of the US tech stocks and generally out of the market.
Yeah, I guess the question is, once you have the washout that we've seen maybe in this part of the cycle, who emerges as the winners, right? Are you convinced by the closing of the gap story and the efficiency story for China, for example?
Yeah, so it's very clear that China has made great progress in terms of open source AI models, cost-effective and capable models. And there's obviously a debate whether this takes now margin away from the frontier labs. It probably does, but it's also a good thing that the spenders of AI, being the cloud and hyperscalers, see a return on that investment. In the last week or so, you've seen operating cash flows of the large hyperscalers starting to re-accelerate. And that's very positive. You're seeing evidence of some software companies seeing AI usage go up in their products. So again, that's very positive in getting the market excited again that this is a real technology and will boost earnings. But also, this is also happening at the backdrop where these Chinese models are allowing US tech, US software companies to use them because they are very capable models, and China is definitely has closed the gap there.
And of course, Sunny, we're seeing the strength when it comes to anything related to AI during this earnings season as well. Not necessarily that the reaction in the markets is reflecting that. Of course, expectations are high. Big day here in Japan for earnings with the weakness in the yen at around, again, back towards 158. What does this mean for stocks going forward into the rest of the year?
Yeah, absolutely. It's an interesting predicament where the yen is today. Because for Japan and the BOJ, stabilization of the yen is quite important to overall sentiment in the markets, because the largest owner of US treasuries is Japan. And so if we see prolonged weakness in the yen, we can then, on the back of that, see many Japanese pension funds looking to unwind treasury positions and repatriate that money back home, putting upward pressure on the long end of the curve. And again, that will then act as a dampener on sentiment and on markets. So in a way, it's going to be important for the BOJ to control the narrative and look to actually hike rates into year end could actually act as a positive catalyst for Japanese equities, rather than what might end up becoming a negative catalyst if the yen weakness prolongs and goes and the BOJ loses control.
It was interesting to see the U.S. and Japan cooperating yen buying for the first time since the 1990s, in part in order to stop Japan selling treasuries, right? They have a new Fed facility available as well when it comes to not having to unload them. Let's talk a little bit about the yield side of things and how that will affect equities as well, because we are seeing multi-year highs, not only for JGB yields, but also for Treasury yields. Of course, we had a little bit of an issue with a big mortgage firm in the U.S., a clear reflection of how long-end yields rising are now having an impact in the broader economy. When you bring that across Asia right now, what are the risks, especially in a market like Japan, who's not seeing rates higher than zero for decades?
Yeah, absolutely. It is something that's now a more, for decades markets got accustomed to low Japanese yields, and Japan had been a funder currency to global markets, particularly EM and EM bond markets. EM equities obviously benefited from that flow in of capital, and that's now at question here with now Japan having to normalize rates. And so in a way, the reforms that Shinzo Abe pushed forward over a decade ago to lift inflation in Japan, have worked. Now it's the BOJ's turn to normalize policy. And that, in a way, will obviously put a bit of pressure on liquidity in Asian markets, drawing back liquidity back into the Japanese bond market. But I think ultimately that's a healthier development for markets to see through this. And the bigger risk, of course, is going to be that this spurs more yen selling, higher and higher yields in Japan, which then translates into the US, and then it forces essentially the Fed to hike, which is something I feel they probably want to have more evidence on the data before they really come to a strong, concrete conclusion that a hike is definitely where they want to head.
Bloomberg equity strategist Sunny Banjaya there in Sydney. Coming up, RBC Capital Markets laureate Calvasina joins us in just a few minutes to talk more about these market opportunities that she's seeing in US stocks.
And of course, we're following the latest on SoftBank, which beat first quarter profit estimates as gains from its Intel stake and a rise in the value of TikTok owner ByteDance helped offset weakness elsewhere in its investment portfolio. Net income fell 18% to 347 billion yen, but topped estimates after the company booked a 1.3 trillion yen gain on Intel shares. SoftBank also disclosing a new $10 billion margin loan backed by its OpenAI stake. The 2-year facility was arranged by banks including Goldman Sachs, JPMorgan, and Mizuho, and requires additional collateral or early repayment if OpenAI's valuation falls sharply. SoftBank's total investment in OpenAI is expected to reach $65 billion by October. We'll break down Japan's earnings season with JPMorgan Securities Chief Japan Equity Strategist Ria Nishihara later this hour. More ahead. This is Bloomberg.
We are watching oil trading with these extended gains now continuing to extend that rally as Iran struck targets in the Strait of Hormuz. We also see this real bifurcation of expectations with this deal with Oman as well, with Tehran seeking to bar US ships as well as restrictions on Israeli ships from the Strait of Hormuz in that deal with Oman. And of course, we know that Washington has insisted on free transit to try and get back to the sort of pre-war situation before February. Iran is pushing for more of a fee structure. So we're at a bit of an impasse when it comes to even this very specific part of a renewed ceasefire. So continuing to watch, and you can see those gains across New York traded crude. We did see Brent seeing bigger gains in the previous session. US futures holding on okay at the moment. It was a pretty volatile session given some of these geopolitical pressures that played out there. Let's bring Laura Calvasina, who's the head of US equity strategy at RBC Capital Markets, for us. So, as we were saying, it has felt like an exceptionally exhausting number of factors. What's top of mind for you at the moment?
So, look, as I've been here this week talking to Australian investors, we've been talking about the Fed, we've been talking about tech, we've been talking about the midterm elections. And I think against the backdrop of all that, right, is just where valuations are. And we actually think if you look at like US versus non-US, you've gotten to a really interesting place again. Basically, after this burst of geographical leadership or broadening, we saw the U.S. is actually looking cheap on a 5-year basis versus rest of world. So we do think that helps dampen, some of the challenges we're dealing with on a day-to-day basis.
Yeah, you can take a look at the chart that is looking at that sort of quality factors, right? Even if you still have to deal with the momentum, the gyrations when it comes to the chip trade in particular, we are seeing a kind of a lid being kept on volatility measures as we've seen the quality and value factors actually improve for the U.S. Yeah. Where do you see that? Because tech actually, if you, I guess, go by the lofty earnings expectations, looks pretty cheap in DM.
Yeah, so, look, I would just say on the quality factor, I cover both large cap and small cap in the U.S., and we've been seeing high earnings quality outperform for a bit now, and we're starting to see it in the large cap space as well. We've been highlighting that to investors this week, saying this is a time to be more selective, and you can think about quality, not just as a quant factor, right, but in selection of management teams, and just being more discriminating within whatever sector you're in. And your point on technology, I think in the financial community, we often say tech. Tech is hiding in a bunch of different sectors, communication services, consumer discretionary is where most of the internet names are. We're having a little bit more challenges on free cash flow. But if you look at the tech sector itself, which is largely semis, hardware, software, it's a cheap sector now. That's not something we could say even, a month or two ago. And so we've actually been pointing people to that sector. And we've said, look, the semis, S&P semis have come back down to 5 and 30-year averages. Software is getting close to historical lows. That doesn't mean every stock within that sector is going to be a winner, but it is a place where value has been unlocked. And at the end of the day, if you're a longer-term investor, you want to look at these volatility, sort of situations in the market and look where value has been unlocked and try to find opportunities.
Well, and in fact, on software, there's now been talk about you start seeing some of the software names taking up AI in more of a efficient way, and that's obviously a little bit more of a bull signal. But the specifics of this is really interesting, right? I think I read a note that said, you need to look for the picks and shovels of the picks and shovels trade.
Right.
What about the trickle-down trade? Is that happening across sort of the broadening when you're saying that you need to be more selective?
We have, our view on the broadening trade has been a little bit different than most strategists. I think a lot of strategists came into this year saying it's time for the market to broaden. And we said, we think this is more of a tug of war, and you're going to see a back and forth between kind of the old leadership and kind of, the rest of the market. And we've had a few twists and turns in that already. And I think that, to be honest, we got to a situation a couple months ago where kind of the old AI tech, mega cap growth leadership got overvalued. I think that valuation problem has been largely solved. And one of the things we're seeing on our data as we go through earnings is that if you look at a broader basket of AI stocks, you've seen a tremendous kind of upside surprise in the earnings growth for 2026, and it's still showing a lot of superiority versus the rest of the market. And so one of the things we've said is that until the rest of the market can give you a better earnings story, we think you're just going to flip-flop back and forth between the two. And when you get the valuation problem on one, you'll go into the other, and then when you solve that, you'll go back again. And I think that's what we're in the middle of right now, frankly.
How much of the views on US tech quality, value, forecasting, is that being challenged by the China AI story?
Look, I think, as we kind of go back and look at some of the things we've heard from the administration in the U.S., they've made it clear that they're sort of fusing economic security and national security, and they want the U.S. to win the AI race. So that's something that's been coming up a bit this week as well when we're talking about U.S. tech. But I think it is also, a source of volatility, right? When we get some of these news developments that sort of challenge that idea of, the U.S. doing well on that front.
We touched a little bit on the Fed. How many questions are you being asked about the Fed outlook? Because obviously we had another sort of instance to be concerned about Fed independence.
Yeah.
Chair Walsh is obviously in a difficult situation, right? Do you feel like the market is underestimating the inflation and the energy impact?
So look, I'll say our rate strategist Blake Gwynn does not have any hikes in his forecast over the next 12 months. Now, he will also tell you that the bar is low for hikes. So, he recognizes that it's a fluid situation and we have to keep an eye on the data. We have to keep an eye on additional Fed speak in the future. But look, I think the reality is that, the bond market is expressing some worry, and frankly, worries that I'm not necessarily seen expressed in the equity market. I think the press conference last week, that has come up in meeting after meeting this week, and I've been pointing people to a chart that basically looks at how the stock market performed in the U.S. after Bernanke, Yellen, and Powell took over. And guess what? Just like Warsh, they had a rough first couple of months on the job from a stock market perspective. But with all three of those, the market was higher a year after they stepped into the job. So, we've looked at the fact that the market has essentially been trading sideways, at least until this week when it's popped. But it had been sort of trading sideways ever since Warsh took over. By historical standards, that is not unusual. It does take financial markets time to get used to a new way of doing things.
Laurie, really great to have you with us. Laurie Calvasina, who's the head of US equity strategy at RBC Capital Markets. More ahead on the Asia trade. This is Bloomberg.
Take a look at how currencies are trading, with the yen now past that 158 level against the U.S. dollar. Of course, we're clawing back some of those gains that we saw during the U.S.-Japan intervention to support the currency. We have heard from Japanese car makers that their forecast is assuming the yen between 150 to 160 through March 2027. It doesn't seem like they have a lot of faith when it comes to the strength of the Japanese yen. And of course, you're seeing the offshore yuan pretty steady at the moment. We're hearing that China's accelerating its push to internationalize the yuan, and at least 6 Chinese commercial banks have adopted a dozen other currencies, Haidi.
Yeah, speaking of China, that's sort of weighing broadly when it comes to some of these commodities trades, right? Both to the upside with copper, but also with iron ore that we're watching. When it comes to copper, we are nearing that record, particularly with this tariff stockpiling situation. Traders assessing stockpiles ahead of potential U.S. tariffs, increasingly tight physical supply situation there. We are seeing modest upside there for gold. We did see a bit of a slip as traders continue to weigh the path ahead for the Fed. More on the geopolitical uncertainty, the impact on global commodities next. Well, the uncertainty when it comes to geopolitics, the US-Iran situation is top of mind again for markets, Shery. As we finish out this week in Asia, we are just hearing at a White House event, President Trump saying that the situation when it comes to the Strait of Hormuz is moving along, that it's good. But, as we've seen from the president, not a great deal of detail has really been had through the course of these talks and negotiations. And now we are seeing signs that there really is another impasse with the various sides very much in disagreement on somewhere to go. With that, we are seeing those continued gains in New York traded oil up by 1%, bigger gains that we saw in Brent in the previous session. So we'll watch to see how Brent trades at the open. But certainly that risk assessment is starting to get a bit more heightened in terms of a more prolonged energy crisis. We're also watching US futures modestly to the upside after what was, not a great session, but of course lots of conversation about the value being found and the valuations for US tech in particular. Japan will be interesting, right? Because we have now, a week since the intervention, not a great deal of momentum driving further yen gains, it seems.
Yeah, we're actually past that 158 against the US dollar at this point, right? Also a big day for Japan because we have more than 700 companies reporting just today. It's big earnings season. We're in the thick of it right now. You mentioned some of those risks around the Iran war. Of course, it's oil prices rising. That also means rising costs, supply chain disruptions. We will be watching for some of that narrative coming from all of these companies reporting earnings, including the likes of Recruit today, Olympus as well. We've already heard some of those yen forecasts from Japanese car makers as well, around 150 to 160 through March of 2027. We'll also be talking about the macroeconomic backdrop. What does rising yields mean for some of these companies as well, especially banks? Let's bring in our next guest to see strength extending beyond the semiconductor sector this earnings season with profit growth drivers broadening. With us now is Nishihara, Chief Japan Equity Strategist at JPMorgan Securities. Ria, it's really good to have you back. What are you seeing so far in the earnings season here?
Yes, corporate earnings are very, very strong. As you said, about more than half of the major companies have reported, and sales growth year on year is 15%, and net income growth is 50%. They are stronger than the peer in US and Europe. And we have to remember that this strong growth, earnings growth, was realized under high oil prices. Japan is an oil-importing company, which means corporate pricing power is, has become very strong structurally, in my view. And the driver of earnings growth, as you say, is broadening beyond the AI semi. Banks, trading companies, wholesale companies, and machinery, those were also the driver of
I was going to say, how much of this strength are you seeing across the board at a time when we've discussed the supply chain disruptions, rising costs, and of course, not to mention on the backdrop of everything is also tariff costs still in play at the moment?
Right. So, Japan's price transfer ratio has, under the deflationary economy, has been 50% compared to 89 to 90% in the US. So, and now, start of the 2023, it's jumped up to 70%. And even under the difficult phases in US tariff in 2025 or higher oil prices this year, actually this price transfer ratio down just a bit, like 68 or so. So still higher than 50% in the deflationary economy. So that makes corporate earnings is still strong. We computed EPS impact by higher oil prices this time will be something like 6% point down. But actually, market consensus is continue to upward revision even after this March.
Do businesses themselves understand the strength of their business right now? The issue with Japan has always been cash hoarding, right? Businesses not spending on the future and not paying their the salaries of employees, so you can see a virtuous cycle of wage growth as well.
Yes.
Are we seeing that change in mindset?
Yes, loan growth is now 6%, which is record high these days. So, which is this is because of the growth of the corporate's appetite to growth investment. It has just started. This is, I think, related with government promotion of growth investment. Corporate governance now focus on how corporates use excess cash in their balance sheet. So, one way is to use for growth investment. Another way is to increase the wage, both of which should lead to a better economy, the circle of good economy.
How are they viewing the strength of the yen right now?
158, yeah. But from a perspective of equity markets, actually, dollar yen below 160 is okay, manageable. Corporate assumption for 26 FY dollar yen is 152 with conservative bias, and 150 is last year's average. So our break-even dollar yen for households' real income growth is 160. So, of course, Takaichi administration's fiscal expansion continue yen weakening pressure, but we also heard last month that government hint a potential GPIF investment shift, and we saw Japan-US joint FX intervention. So such flow of funds policy would be some supportive factor to reduce the further yen weakening pressure.
Where's JPMorgan seeing the yen year-end?
Yeah, 164, no change year-end.
Okay,
So,
despite everything that has happened with joint intervention.
Yeah, from now, still 4 months from now. So, but there is also risks in a short term. Such government address should keep yen a bit strong.
Yeah, not to mention, of course, BOJ decisions as well. When it comes to these businesses, we talked about the strength of the semiconductor side of things, and we talked about the broadening of it, machinery, other sectors like banks as well. Are there any outstanding to you that you think have more potential going forward?
Yes, I overweight banks from structural perspective, like for medium term, time horizon. Some investors see the bank's valuation, current PB 1.5 times, PE 15 times, already pricing to BOJ rate hike. So what else? But my view is, long growth is one thing. This is the start of the cycle of strong growth investment. Another thing is potential deposit shift. Deposit shift makes banks who has resilience to deposit beta, long-term rates rising, or upgraded cyber attack can be winner. Through this process, I think deposit yield, loan yield will be normalized from a level under deflationary economy. That is catalyst that has not been in EPS or ROE. So I think further upside in medium term will be justified, can be justified.
I mean, all three mega cap banks have beat their estimates this quarter, right? So it seems to be almost consensus that there's more upside for financials. But Ian Nishihara, it's really good to have you with us, Chief Japan Equity Strategist at JPMorgan Securities. And of course, we do have a few earnings to watch today. More than 700 companies reporting results. SoftBank is one that we're closely watching. Their quarterly net income fell only 18% to 347 billion yen. That was above estimates. Unrealized gains from Intel really offsetting some weaker Vision Fund holdings. And Nintendo's report card also showed stronger than expected earnings. It got a boost from tariff refunds with the U.S. and strong sales of in-house titles for its flagship Switch 2 console. Net income came in at $934 million, beating estimates. ADRs closed at a 7% premium in the U.S., Haidi.
Let's get you caught up with some of the corporate headlines that we're following this hour, Shery. And Singapore lender OCBC's second quarter profit topped estimates helped by strong insurance and wealth management fees. The bank saw net income rise 22% to $1.7 billion and reaffirmed plans to complete its capital return program this year. UOB also reported earnings in line with expectations. Profit rose 10% there to $1.15 billion, underpinned by wealth management fees that helped offset declines in lending income. Shares in United Wholesale Mortgage ended the session nearly 35% lower after the mortgage lender announced a net loss of $452 million and suspended its dividend for the first time. The company also unveiled a dollar equity capital investment by Oaktree Capital Management and SFS Group Capital of around $2 billion and a new investment vehicle owned by UWM's Chief Executive Officer, Matt Ishbia, and his family. Jane Street is said to be in talks to refinance $11 billion of debt with investors including PIMCO in what could become one of the largest private credit deals on Wall Street. The FT reporting that the financing could be upsized to as much as $15 billion and completed as soon as next week. The trading firm is looking to shift its borrowing from public markets to private lenders, providing flexibility and limiting financial disclosures. More ahead on the Asia trade, this is Bloomberg. Bloomberg has learnt that DeepSeek is resuming its second funding round, seeking close to $8 billion. Let's bring our China correspondent Min Lo for the latest. What do we know about this? How much interest is there?
Yeah, we know that Monolith is one of the companies that might be contributing to this round of fundraising, but not much clarity yet on who else would be involved. But we know the first round of fundraising had drawn interest from the likes of Alibaba, Tencent, as well as the National Artificial Intelligence Investment Fund. So likely still to be a lot of interest in this company that has been such an icon in the Chinese AI space, right? It's seeking to raise close to $8 billion at a valuation of 500 billion yuan. This is a step up from the 350 billion yuan that it raised in the first round, and some of that funding is likely to help fund its data center build out, because we previously reported that the company was looking to build a 1 gigawatt data center in Inner Mongolia. So yes, also a lot of interest, particularly after the release of that V4 Flash, which was very successful and also priced very aggressively, so much so that there is this idea now of the DeepSeek death zone, where if your model is less capable or is at the same level of performance but priced higher, you might not be able to survive.
Speaking of prices, so much of this has been the cheap pricing that we've seen from Chinese models, right? So what do we make of this price hike? And is it being seen as something of a turning point for these Chinese AI models?
Yeah, it was quite an unexpected news release yesterday when DeepSeek announced it would be significantly hiking prices after the discounts that it offered on the V4 Flash. Not clear yet. It hasn't provided details as to how big the price hike is, but it's giving a warning to clients to start preparing for that move. But yes, you combine with the news of the fundraising, perhaps there's a little bit more pressure now from external investors for the company to pursue profitability. And to your point, it's probably seen as a good thing and a potentially an inflection point that would relieve the pressure valve a little bit and give some room for other companies to raise prices as well. So this could bode well for the broader AI sector in general, when there has been so much pressure when it comes to monetization.
Bloomberg China correspondent Min Lo there with the latest, as we're also awaiting the open of South Korea. Of course, take a look at how we're setting up. Samsung Electronics pointing to some upside of 0.9%. Here in Japan, we're also watching Kioxia Holdings. The broad South Korea market has been pretty active, right? We're talking about a plunge of about 5% just yesterday as well. This coming as we're continuing to see this deep deleveraging in the South Korea market. Interestingly enough, the Korean won, though, has seen some highs against the U.S. dollar, as we're seeing some exporter flows together supporting the won, and perhaps a little bit of that speculation and perhaps flows coming from the SK Hynix ADRs listed in the U.S. as well. A lot of memory headlines today, especially out of those U.S. peers reporting earnings as well. Let's bring in Bloomberg Markets reporter Anthony Stevens for the setup to Korea. So, Anthony, I mean, there's a lot, right? Western Digital, there's SanDisk as well. How is this going to really affect the trade across Asia?
Yeah, so we saw Korea quite weak yesterday ahead of those earnings, because those earnings were out in our time zone. And in the US, yes, those stocks were weak. And it was very interesting what the Western Digital management said. It said that, look, earnings expectations were very high going into earnings, so it should not be as much of a surprise that the stock kind of reverted. Demand is still very strong. So this sets up this dynamic of demand being strong very much at the front end of the curve. People know that demand is booked out pretty much until 2027. And there are some confirmation headlines now from a range of media sources saying that HBM demand is booked out into 2027. But you're also seeing some kind of demand destruction on memory demand from the pricing, right? You're getting pushback on this idea that, that there will be DRAM supply coming and people want to keep paying up these prices for DRAM. And that demand versus supply kind of dynamic and that debate is what is driving memory here. So we have this headline out from the information that NVIDIA is looking to reduce memory usage in its top-of-the-line chips. And this goes alongside Chinese innovation in pretty much the same area on how do we reduce the memory intensivity of the kind of go-forward technology, right? While this capacity is booked out, at the same time, you see Apple, there's speculation that Apple is failing to get a memory price cut from CXMT. So that market is very tight, and what can be done about it seems to be determining the future price action. Now, one thing that you kind of touched on is retail positioning in the space has come off pretty materially. So, for example, it was interesting to see Weston Digital and SanDisk, despite having a very sharp move lower after earnings, saw implied volatility fall. And that's something we've seen in Korea recently as well. As the market falls, implied volatility in Korea is kind of stuck. It's not reacting in a panic fashion. So maybe some of this retail deleveraging sets a kind of a flow underpinning for the memory trade going forward.
And then given all of the volatility that we've seen in tech stocks, especially with the ongoing on and off sell-off as well, Anthony, it's interesting to see that Citadel is taking this perhaps as a chance to reset. Talk us through that.
Yeah, they talk about it as a technical/flow reset, right? So some of those trends I alluded to earlier, the crazy kind of retail demand for upside volatility, that has kind of come off a little bit. Retail flows into technology space as a whole have come off quite materially in line with the semiconductor index in the US as well. And this has coincided with quite a strong earnings season. So fundamentals are improving just as kind of the most exaggerated upside flows start to abate. So you have a slightly cleaner picture in terms of positioning to play these fundamentals. But on the other hand, the price action is likely to be less aggressive to the upside as a result. So it's going to be more of a slow grind to the upside as fundamentals get repriced. That is the crux of their report, in that the focus moves to the fundamentals and away from aggressive chasing of flow as the excitement around the picture of AI becomes a more mature story around who is executing, what capacity is coming online, and how is the technology maturing.
Yeah, perhaps we can all step back a little bit and breathe. Anthony Stevens, markets reporter there for Bloomberg, of course, with the latest on the moves. And more ahead on the Asia trade. This is Bloomberg.
Sequoia Capital says Situational Awareness has invested $400 million in a company that it has backed. Sequoia's partner, Patrick Grady, also told Bloomberg that Leopold Aschenbrenner had approached the firm about taking over some positions.
It has been reported that we were talking with them about the Anthropic stake. You know, King Griffin showed up with what was a better solution for Leopold at that moment in time, and he went with the better solution. I think that our observation is that there is this game on the field over the last couple of years investing in the AI supply chain. Leopold was one of the first people to recognize that that was the game on the field. And on balance, he played it pretty darn well. And so our suspicion is that he's going to be a fixture in Silicon Valley for a long time to come.
I wanted to get to the Valar case study. We've talked a bit about Sean.
Please
go ahead. Yeah.
On situational awareness, he did just wire $400 million to a company that we invested in. So.
Oh, we actually reported on the $400 million, but I haven't got a clue who the company is.
Yeah, no comment on that. But he's not.
It's a good one.
He's not. He's going to be. He's really good. He's going to be around.
On the topic of Anthropic, they also acknowledged that the firm was behind the curve when it comes to the AI startup. Sequoia eventually agreed to invest $2.5 billion in the company. Both Patrick Grady and Alfred Lin spoke with Ed Ludlow about that investment strategy.
This is the tectonic shift of our lifetime. In a perfect world, we would have backed Anthropic many years ago. We didn't. And so the best thing we can do now is to come in at the most scale that we can muster. And so $5 billion was kind of a theoretical number mentioned to be provocative. We ended up at 2.5 because we can't really do $5 billion across all of our different funds, and so 2.5 is kind of the most we can do, and that's sort of how we ended up with that number.
Is it fair to go as far as to say, like, how much money can we deploy without putting the firm at risk?
Yeah, that was part of the conversation. 2.5 or 5 would be comfortable numbers as far as that goes. But one thing, we've never done SPVs. We're not in this SPV business where you speak for something.
I think we have enough time today to talk about SPVs.
Yeah, so we don't do that stuff. And so $2.5 billion was what we could do out of the core fund's committed capital.
Yeah. Let me ask you this, or give some background. Growth, early stage. Since 2017, you've led the growth, you've co-led early stage, but SaaS, consumer, but there's a lot of overlap, right? You have made significant growth stage investments and joined boards. You've made early stage investments, particularly in AI. Just talk a little bit about how the two of you see that progressing, forward looking.
I think it's very, very simple, which is like if you've been in this business a long period of time, you know what a good early stage investment looks like. You know what a good growth investment looks like. So Pat has been traditionally a growth investor. He made the early investment in Harvey. I've seen how early stage companies grow and advocated for growth investments in Airbnb and DoorDash when they grew up. And over time, I think if you've been in this business long enough, you'll make both early investments and growth investments. We have Constantine that championed Citadel Securities and Waymo. Yeah. We talked about Shan. We have David that has invested in a NeoLab that's relatively early. We have Sonia, who's recently sort of flew with me to London to advocate for the investment in Ineffable. So our team is much more fluid, and we don't. Just going back to like most of our partners don't like being put in a box.
Sequoia's Patrick Grady and Alfred Lin speaking with Bloomberg's Ed Ludlow. Take a look at how we're setting up for the market opens across Japan and South Korea in about 6 minutes. The yen at the moment holding at that 158 level, past that 158 level against the U.S. dollar. Of course, we had seen some strength after the U.S.-Japan joint intervention, joint yen buying for the first time since 1998. But we're seeing again a weakness now suppressing the strength of the yen at the moment. We continue to watch earnings results. More than 700 Japanese companies are scheduled to report today, including Recruit Holdings, Olympus as well. Nikkei futures pointing to a little bit of upside. SoftBank already reported after the close yesterday. Quarterly net income fell only 18% and came in above estimates. We also had Nintendo coming in with net income of $934 million, almost double the consensus after they got a U.S. tariff refund. So Kospi futures pointing to some upside. We'll be watching some of those memory names given the plunge in SanDisk and Western Digital overnight. The market opens in Sydney, Seoul, and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens as oil continues to gain ground. We're seeing yields rise and really that pressure on risk assets, Haidi. And we haven't even digested U.S. payrolls data coming out on Friday yet, not to mention tons of earnings here in Japan.
Oh, it is just a hectic time, isn't it? And it's interesting. We'll be watching the earnings season in Japan with 700 plus companies. And of course, at a time when just a week on from the dramatic burst of joint intervention in the yen, we're seeing really a struggle for the currency to maintain those gains. So just a myriad of things for investors to be watching for.
The yen passed that 158 level against the U.S. dollar, already weakening again. And this, of course, after all of that yen buying that Heidi just mentioned by Japan and the U.S., the first coordinated one since 1998. But we're seeing the pressure on the currency increasing. When it comes to those companies, more than 700 reporting today, we're talking about the likes of Recruit Holdings. We're talking about Olympus as well. The Nikkei opening higher, 0.1%, but a lot of variables in today's session as well, given, of course, the uncertainty around the Japanese yen. Interestingly, Japanese car makers came out and they forecast their yen assumptions until next year, and they see it around 150, 160, so not really any meaningful appreciation of the currency as of yet. Also, JGBs, do keep an eye on them because we actually saw solid demand on the 30-year JGB auction yesterday, so we'll be watching the 10-year yield at around that 280 as well. Take a look at how South Korea is opening, because in today's session, whether it's Japan Japan, whether it's South Korea. We have to watch those memory makers. We had the likes of SanDisk, we had Western Digital also plunging after their earnings results. So we could potentially see some volatility in the stocks in this part of the session. Although in early trading in South Korea, we are seeing some upside for Samsung, SK Hynix as well. A lot of volatility for the Kospi, right? I mean, we're talking about already losses of more than 5% just in the previous trading session. So right now, a little bit of upside, recouping some of those losses. The Korean won 14.24. What's been interesting is that despite the fact that we have seen weakness in the equity side of things, we have seen some exporter flows really supporting the Korean currency, which is now at around a 10-month high, and it's the best performing Asian currency, Haidi, when in fact the first half of the year it was actually the worst performer.
So many trades are being turned on their heads right now. And to that point, we're kind of seeing some pressure coming for treasuries at the moment. Of course, the renewed questions as to the path ahead for the Fed. We also heard potential more questions over Fed independence as well with these communications or the efforts being made by President Trump. So treasuries falling in the overnight session, certainly as these oil prices continue to rebound from 3-week lows as well. So these expectations as to what the Fed might do with its rate hike path are really very much in flux at the moment. These expectations have mounted further after we heard that report that Chairman Walsh is prepared to hike if inflation readings in the coming weeks come in hotter than he'd like. Oil, of course, will be a big part of that as we see the continued gain in this session. Brent crude coming online high by 1% after gains in the previous session as well. These reports that Iran attacked hostile targets in the Strait of Hormuz, disagreement over whether US and Israeli ships will be allowed to pass in this fee structure that Iran is pushing for as well. We've had quite a heady week when it comes to Australian stocks. The ASX at the moment opening lower by 0.5% after, of course, that record high earlier in the week, Shery.
And Heidi, will be watching one stock in particular here in Japan, SoftBank, posting a beat in its first quarter profit with gains from its Intel stake and a rise in the value of ByteDance, helping offset weaker performance elsewhere in its portfolio. But the focus for investors remains on its growing exposure to OpenAI and when those AI bets will begin to translate into meaningful returns. Bloomberg Markets reporter Anthony Stevens joins us now with more on this. And Anthony, it seems that at least for now, SoftBank was saved by the likes of Intel, by the likes of ByteDance, for example, as sort of a bridge until it can actually get to some earnings from OpenAI.
Yes, SoftBank has benefited from this kind of diversified approach into the AI space, right? They have a big portfolio of companies across the AI value chain, and it looks like they were saved by the chip makers while there was weakness in the chip takers. Now, the ability to play that whole cycle is kind of SoftBank's big bet, right? And we had management push back on the idea of an AI bubble quite aggressively. Now, the focus on the results, as far as the ADR trading session was concerned, is not that the company made more money. It's the 5th quarter of positive net income. So that was quite positive. The focus moved over to funding these bets. SoftBank CDS has been tracking higher. The cost of funding for any incremental AI bets has been going up in the bond markets, with the exception of the US hyperscalers. So there's a lot of pressure on the funding side. So if you look at SoftBank as a giant hedge fund betting on AI, they're getting pressure on funding the bets, not on the performance themselves. And that increases the pressure to list some of these holdings. The holdings that they have listed have, of course, done really well, ARM being a great example. So the market wants to see them execute, not just invest. They need to get these things to capital markets and kind of capture some of that value. Now, going forward, what will be very interesting is whether OpenAI can stave off some of those Chinese competition concerns and maintain its value. Similarly, ByteDance faces domestic competition in the video market, kind of challenging some of its monopoly position. So it's very interesting how the technology space continues to evolve in SoftBank's book, and the complexity of getting these names to market will become the new focus for markets here.
At the same time, though, Anthony, we are seeing SoftBank carrying on with its support of the AI build-out, right? Whether it's data centers, whether it's more business around robotics, energy as well.
Yeah, and given their portfolio, right, they probably have a high degree of visibility across the chain. So their continued conviction is very important. Now, it's also important because SoftBank is a major fundraiser for a lot of the companies that it does support. It puts its balance sheet behind these companies as kind of a bridge financing between the cash-up semiconductor makers and the cash-strapped AI model makers. So their role is very important, and as a result, their financial health is extremely important to the AI supply chain. And also their involvement in the US makes them a very pivotal part of this East-West bridge that President Trump and others are trying to bridge between the US AI ecosystem and the Asian manufacturers. So it's playing a very pivotal role, and it needs to play this role of maintaining confidence and holding the line even though its own financials start to get stressed. Now, it's for the markets as a whole, this is a great result. For SoftBank in particular and its bond investors in particular, the aggressiveness of their approach continues to be a focus.
Bloomberg Markets reporter Anthony Stevens there with the latest on SoftBank. And of course, we have plenty more companies reporting earnings here in Japan, more than 700 of them, including Recruit, Olympus as well. Let's bring in Chris Weston to discuss the broader markets. He's the head of research at Pepperstone Group. Chris, great to have you with us. I mean, we were talking about SoftBank as really a proxy for the AI trade, for OpenAI, not to mention their investments in AI infrastructure. We're seeing this sharp divide between the AI winners now, because in the overnight session, we had Western Digital, also SanDisk just plunging. What differentiates the winners and losers at this point in time in the AI frenzy?
Well, I think positioning is such a big part of it now. I mean, the memory space has come off completely, and we've seen that now with SK Hynix and Samsung. They had a bit of a bounce last couple of days, but now they're back printing new lows in this run that we've been seeing recently. And we know the memory story is still a winner for 2026, 2027. But the price action is just absolutely terrible at the moment. And, shorts are having an easy time because the buyers just aren't, picking up the stock at the moment, and they're having an easier time of pushing this one lower. So we all still know that memory is still a really integral part. And even CXMT in China has come off, from those recent highs post IPO. And that's starting to trade a little bit more poorly as well, as people look to take some profits off the table after that amazing IPO that we've been seing. But I think a lot of the capital now has flown into the hyperscalers. I mean, we saw, some very, very, very strong results coming through. We all know that, but everyone's trying to understand the return on invested capital from what we've been seeing from the capex so far, and where the capex is going for. And we have seen some really clear signs that that's starting to develop. So capital is going into the first derivative of this, into the hyperscalers. Microsoft numbers, they're three. What we've seen from Copilot now. 30 million customers there. That's growing. They're starting to monetize that. That return on invested capital is starting to show credence. We've seen that in Amazon as well, with their AI revenues really picking up quite sharply. Alphabet as well on the TPU side. They are monetizing this, and I think people are having more conviction there. So the capital flows into the hyperscalers, and they've come off the boil a little bit last night. But certainly Microsoft's looking good at the moment, and I think people are moving away from that. What has been a very, very strong momentum. Key components there.
When it comes to anything related to AI and the AI trade and earnings results around it, how compelling are they, as opposed to, say, the macro news right now that has again reversed itself, with oil continuing to gain ground?
Yeah, it's a difficult one. I mean, I think when you see oil out of the spotlight, and that doesn't really happen too often, but I think when they see the volatility subside and it gives investors a chance to really look at the fundamentals in the equity market, then we do see some very, very, very encouraging signs. I mean, growth in the US is sort of running at about 5% if you look at the Atlanta Fed model. People are taking down volatility bets. I mean, 1 month S&P skew is fairly balanced at the moment. I think people have taken that down. We need to see it a little bit lower to get the vol targeting funds back into the market. But we've done about 88% of number of companies coming out of the S&P who have reported, and the companies that have beaten expectations, which is obviously a very large amount, have done so on earnings, have beaten on average by about 29%. What we've seen over the last 4 weeks as well is that blended forward EPS growth for this year is up, quite nicely. We've taken it up significantly through this year. For next year as well, we've seen analyst consensus revised up about 2.5%. So it does allow that multiple to come down. And I think, with the absence of oil, and we just saw the sensitivities earlier in this week, as soon as crude comes off, and it comes out, people start thinking perhaps we can get past this and see a world where Hormuz normalizes. And that's obviously been very, very or completely non-linear, then we can have a chance to reflect on the fundamentals, which are still very, very positive, and corporate US is clearly delivering.
But the thing is that when you have a rebound in oil, you have the repricing of rate hikes, whether it's from the Fed or the other central banks, right? Yields now surging. Then you have also the repricing of long duration AI valuations. At what point do higher yields start to really limit those gains in the AI related rallies in stocks?
Yeah, it's a great question. I mean, I think what we've seen, if we look at the 230s curve, is we've hit a ceiling at 100 basis points. I think, if that breaks that point to a material degree, and of course it's not just the level that people look at, but it's the rate of change that makes life a bit harder. And that's where you start saying to yourself, well, we've seen a massive deluge of corporate bond supply coming through this year. A lot of it's been front loaded, but there's still a significant, like $130 billion of IG corporate debt still to go throughout the rest of the year. And of course, the higher long end yields go, of course, then it means that the companies coming to market for that raising to fund future credit expansions, which, as I say, is still a lot to go, then they have to bring out and incentivize the corporate bond market to go out and fund that. And if they're pricing it above the long end of the curve, then do they need to come out and reduce duration on those maturities that they're funding? And what sort of incentive do they need to go above the Treasury market to try and get this away, given there is choice for investors to go through, and some of that corporate debt is still very attractive. So I think it makes life problematic for funding this future capex expansion.
Right.
It makes the present value of that lower as well, although I think the break-even rates are very high. So it does become problematic, but I think at the moment it's more about the rate of change rather than absolute levels.
So how big of a risk is the Friday's U.S. payrolls that we're expecting now in the broader macroeconomic stability right now in the markets?
It's difficult to say. I mean, if you look at the price action that we've got in one year forward rates in the US, they're sort of stuck in a range. 10-year real rates, have been consolidating in a 7 basis point range for the last 7 days or so. And I think that's just thematic that the market is really just not sure what to do now, because we've got a really nice balanced pricing for the September Fed meeting in terms of swaps. And the market just needs to know more about the Fed's reaction function. And they've just been very cagey about that situation. I mean, Kevin Walsh has been giving us very, very little. And so pricing risk onto this payrolls number is very much a challenge. It always is, in the fact that, what do we look at? Do we look at where the absolute job numbers come in, the revisions, the unemployment rate? But then, you've got to work out how much of this influences the Fed meeting. And even we've got a CPI number next week, which is expected to dissipate slightly. So the Fed has given us huge ambiguity as to what's going on at the moment. The market, therefore, is pricing, this kind of balanced situation, this uncertainty. So therefore, it's very difficult to see exactly how the markets are going to fare, where the balance of risk is at the moment, because everything is in balance. And we're just waiting for the numbers to come out and then for to get some meat on the bone from Kevin Walsh. But I think he is giving us very little on purpose, and I think that's just could make life a little bit more volatile in the front end of the curve.
Chris Weston, good to have you with us, head of research at Pepperstone, as we're watching the early moves across markets here in Asia, especially Nintendo, because their first quarter operating income beat estimates. You can see the gains of more than 3%. The $934 million for net income was almost double consensus after U.S. Tariffs were refunded to the company. We also saw strong Switch 2 titles, but we will be watching for that memory inflation and what the impact could be to the broader Japanese consumer electronics sector, Haidi?
Yeah, take a look at what we're seeing across software, because at a time when we are seeing a little bit sort of more upside in the software sector because of these hopes that with the AI take-up that perhaps you see a bit of a recovery, we are broadly now seeing downside, though, particularly when it comes to WiseTech. Of course, that has been just such a volatile stock here in Australia. We're seeing some of the other Aussie names, Xero, Technology One there, also trading by as low as 1.4%. Datadog, HubSpot, Figma results coming through, and not they would, broadly sort of didn't manage to convince investors that we're ready for this turnaround in the sector just yet. Also watching some of the mining stocks, which of course have been some of the big gainers that have propelled the ASX to that record high this week. We're seeing, though, a little bit more of a pullback for Rio Tinto, BHP Group there as well. Some of the iron ore names have been in focus this week, but we could see some gains ahead of that meeting with President Trump. And of course, we have seen also some of that stockpiling concerns ahead of tariff decisions that are expected from the president as well. More ahead on the Asia trade. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
The labour market backdrop still pretty decent.
When you take a look at wages, when you take a look at the JOLTS data today and the quits rate, that's going to matter.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market seems okay.
We don't see any wage pressures in the economy.
We're all building up to one thing.
The July jobs report, today on Bloomberg.
Bloomberg has learned that DeepSeek is resuming its second funding round, seeking close to $8 billion. Let's bring our China correspondent, Min Lo, for more. So do we know much about the level of interest, given just how much interest, of course, there is in broader China AI at the moment?
Yeah, the fundraising rounds have been coming fast and furious so soon after it closed its first round of fundraising, which had drawn interest from the likes of Alibaba, Tencent, and the National Artificial Intelligence Investment Fund. This time, in the second round of fundraising, the company is seeking to secure a valuation of 500 billion yuan. That is an increase from the previous 350 billion yuan in the first round. We understand that Monolith Management will be contributing to this round of fundraising, and certainly a lot of interest, particularly after the company released that V4 Flash model, which has been very successful, has been topping some leaderboards in terms of the most used model, and that's thanks to some of the deep discounts it's been offering when it comes to prices as well. And the company is, of course, looking to invest in its data center build out. We previously reported that it was planning to build a 1 gigawatt data center in Inner Mongolia. That is something that could cost, up to $50 billion, according to estimates by NVIDIA's Jensen Huang. So certainly a lot of capital investment needed as the company looks to potentially file for an IPO even as soon as this year, according to what sources are telling us.
The pricing you mentioned is so interesting, right? Because the economics of China versus the US with these models, the pricing discount has been such a big part of the story. So how does this price hike play into things?
That's right. DeepSeek is now priced at cents compared to several dollars that U.S. frontier models are charging. So a huge difference, as you said. But DeepSeek also just announced yesterday that it's about to start hiking prices aggressively. It didn't give details as to how much it's going to raise prices, but this is, some analysts say, a step in the right direction to at least relieve a bit of that pressure. And it could be an inflection point for other companies to follow suit to lift prices as well. So it could bode well for the AI sector in general. And it's coming as, of course, the company seeks external funds and that possibly is putting more pressure on the company to pursue more profitability as well. Because at this rate, some analysts are saying that these companies are still making losses when they're priced so cheaply. So it's not really sustainable in the long run.
Bloomberg's China correspondent Min Min Lo there. The latest on DeepSeek. Some of the other stories that we're following in this tech space, of course, Alphabet selling $25 billion of investment-grade bonds in one of the year's largest order books for AI-related debt, helped by generous yield payouts. Sources say Thursday's offering attracted some $115 billion of peak demand. The sale lifts Alphabet's debt issuance since 2025 to more than $114 billion, making it the biggest seller of AI-related bonds over that period. Millennium Management is partnering with Anthropic to build an AI-powered risk analyst using the company's Claude models. Engineers from both firms will develop tools to help risk managers uncover new insights and make decisions across asset classes. The partnership is part of Millennium's AI Laboratory initiative, which is aimed at collaboration and attracting top tech talent. More ahead here in the Asia trade, this is Bloomberg. Take a look at what we're watching when it comes to oil prices, holding on to those gains as we continue to see this uncertainty over the ceasefire talks, particularly pertaining to this deal with the Hormuz deal, really under threat at the moment, given that Iran is seeking to bar US and Israeli ships from the Strait, wanting compensation from hostile countries before they're allowed to pass through, according to local media reports. So this proposed Iran-Oman deal that has attracted so much optimism this week is now very much endangered. We're seeing Brent crude up by about 1.5% in early trade. European gas futures, nat gas futures, are also up by close to 5% there. So President Trump, though, has reiterated that the water remains under US control. Our Bloomberg managing editor Jill Dacis joins us now for more on this. And so it feels a little bit like we're back to square one. Even just this sort of effort to bring essentially the Strait of Hormuz back to the pre-war situation, before February, seems to be a very tough battle right now.
Yes, Heidi, it really does seem like we're constantly in this push-pull holding pattern. I mean, I would also point out that despite Trump's remarks just there, recall that it was at this point more than 48 hours ago that Trump said that some kind of a deal, or indicated some kind of a deal, would be reached within 48 hours. Obviously, we're not really there at this point. Instead, if anything, one expert we talked to said it seems like both sides are interested in escalating the demands rather than making any kind of concessions, and point to this deal that is in the works potentially between Iran and Oman that would ultimately impose some tolls on hostile nations, specifically targeting the U.S. and Israel for transiting through the strait. So you've got already, in addition to the prospect of a U.S.-Iran deal looking less likely, some other issues that are coming up as well.
And in fact, we heard from President Trump at a White House event just in the last hour saying that things are going good, right? It doesn't seem like we know much more as to, what the next steps are. But how much pressure is there? I mean, we are coming up to midterms, and this is not even dealing with some of the trickier issues in that broader ceasefire.
Yes, that's right, Heidi. I mean, remember that when you're looking at the ceasefire, it's not just about control over the Strait of Hormuz. It's also about managing Iran's nuclear capabilities. A lot of concerns around there that already did seem very difficult to resolve when they went into those peace talks back in June. Look, this has been the same narrative at this point for several months. We're approaching ever quickeningly the November midterms in the United States. Obviously, massive domestically, but what it says about price pressures, inflation, that kind of thing, also has to be weighing on the mind of President Donald Trump.
Bloomberg managing editor Jill Dacis there as we continue to watch for the next developments. More ahead on the Asia trade. This is Bloomberg.
Take a look at how Japanese assets are trading early in the morning session today. We're seeing downside on the Nikkei. Energy stocks are gaining ground today because of the rise in oil prices, with Brent around $83 a barrel on Iran-U.S. tensions. But at the same time, we have information tech as one of the big losers today, especially when it comes to semiconductor equipment makers, Advantage, Tokyo Electron, Lasertech, Disco as well. All of them are down today. Not surprising, perhaps, because in the overnight session, we saw Western Digital, SanDisk also falling after results. So memory names across the board in Asia, you'll have to keep an eye on. 10-year yields holding at that 279 level. We had a solid 30-year auction just yesterday. Do watch out for the Japanese yen, 158. Mid 158 is the level, still weakening past that level, despite, of course, earlier intervention by the U.S. and Japan, the first yen buying since 1998. We're watching the Topix. Right now, a little bit of divergence with the Nikkei. The Topix actually gaining 0.2%. It's preparing for its biggest overhaul in years. Small caps could be fighting to keep their place in the index. Bloomberg senior equities reporter Hideyuki Sano joins us with a preview. So we're talking about more than 600 companies that could be eliminated starting October. Why?
Right. So yeah, this is the biggest overhaul of the Topix history, dating back to 1960s. And investors long complained that Topix had far too many companies. At one point, it had more than 2,000 companies. And in 2022, they cut back on the number to 1,600. Or so, but still that's far more than S&P 500, for instance. And for investors, that means extra cost to replicate because there are so many small illiquid stocks. And so the Tokyo Stock Exchange has basically decided to cull the stocks that together make up the lowest 3% of market cap.
So what does it mean for those companies that are getting eliminated?
Yeah, so they are not going to get investment from passive investors. And by the Tokyo Stock Exchange's estimate, about $1 trillion fund will be benchmarked to the Topix. So it's a very big amount. And so there's a fierce competition now among some small cap companies. And it's almost a bit like Squid Game because the Tokyo Stock Exchange is going to review this, do this review every year from 2028. So if your company's market cap is too small, then you'll be out from the Topix. So I mean, the Tokyo Stock Exchange is not as brutal as Squid Game. So it's not going to eliminate all companies until only one is left. But still, companies feel a lot of pressure to keep stock prices up. So this is also related to the governance reform as well.
So before I let you go, Hide, I also wanted to ask you about the government pension investment fund, because there's been a lot of focus on it given the government's rhetoric about potentially them investing more in Japanese assets. We're getting some of their updates when it comes to allocations. What can we expect?
Yeah, so GP is going to announce its result for April to June quarter. And so that's the period before Katayama and Takaichi made comments about GPIF. So most investors do not expect any major changes to GPIF's portfolio. But if GPIF had done anything abnormal, then that would certainly fuel speculation that GPIF may be actually moving towards investing more in Japanese assets.
Is this an encouragement from the government, or can the government actually do something?
That's hard to say. At this point, I think there's a lot of skepticism about what kind of changes the government can make. And there are several reasons. But at the moment, the GPIF had an equal 25% target on 4 main categories, which is domestic bonds, domestic stocks, foreign stocks, and foreign bonds. And in recent years, the GPIF has been quite strict about following this target, even though it's permitted to deviate from that target. And at the moment, it's questionable if professionals at GPIF may have a reason to increase yen assets when the yen needs government help.
Yeah, at 158 at the moment.
Yeah.
Hideyuki Sano, Bloomberg senior equities reporter, here with the latest on the some of the Japanese companies that we need to keep an eye on, including, of course, Fujifilm right now breaking on the Bloomberg. We're talking about a fall of as much as 18% at some point today. We have heard from Fujifilm that they have started an assessment of a partial spin-off of its business innovation operations. So we'll continue to watch that developing story. But as Hideyuki was also talking to us through the Japanese yen and its implications on broader portfolio holdings, we are trading at that mid-158 level against the U.S. dollar, despite, of course, significant gains that we saw after the U.S.-Japan intervention in the currency. Bloomberg's chief Asia FX and rates correspondent Ruth Carson joins us now with the latest on what to expect from the yen. So, Ruth, at that 158 level, what are we talking about being the imminent risks to yen positioning?
Yeah, it's absolutely incredible, Shery, that we had historic joint intervention between the US and Japan less than a week ago. And here we have a dollar yen that's given up half of its losses, you know, and heading into a very pivotal US NFP event tonight as well. As for immediate risks to the yen, it just shows you how fragile yen strength, if we can call it that, is. Yes, there are imminent risks. One of them, the jobs numbers tonight. If it comes in hot, the dollar will be bought. Absolutely. You know, and if treasuries do sell off on the back of that, that pushes up yields, and that in turn could get people even more into the dollar. And we know that the yen, the third most traded currency in the world, would come under pressure. On top of that, what's going to happen this weekend when it comes to US and Iran tensions? Because we know that there are all these headlines flying about geopolitical tensions there. Oil prices are up. This again would put pressure on the yen immediately.
We have seen some weakness on the U.S. dollar on the other side of the trade against G10 currencies, though. I know the risk that you mentioned around the U.S. jobs numbers tonight, not to mention Iran-U.S. tensions. But what does this imply when it comes to the effectiveness of yen intervention?
Yeah, absolutely. And the yen plays a big part here when it comes to that dollar weakness. If we run WCRS Go on the terminal and change it to about a 1 month timeline, absolutely, without a doubt, the numbers show that the dollar is down against most G10 peers, including the yen. But that said, you know, FX markets are indeed the biggest in the world. It's $9.5 trillion a day, and it's very liquid. It can also be very mercurial. And remember, in times of stress, no doubt, undoubtedly, king dollar is king for a reason. So people tend to flock to it. Now, tonight will be a big test when it comes to dollar yen. If the numbers do come in hot, we could see the dollar bid again. And then investors increasingly question the effectiveness of that joint intervention.
Ruth Carson, Bloomberg's chief Asia FX rates correspondent, there with the latest on what to expect on the currency here in Japan. We have more ahead. This is Bloomberg.
We are watching the gains that continue to pile on when it comes to copper, near a record high on these expectations of tariff decisions from the US government. So we are trading near that record, assessing that stockpiling situation as well. We're looking at an increasingly tight physical supply situation outside of the US as well. So the support from the tariff-driven factors as well as these broader market conditions are continuing to move that higher there. We are seeing, though, some downside when it comes to gold, edging lower and snapping that 3-day advance as a renewed surge in oil prices as a result of what looks like the ceasefire deal, the deal on the Strait of Hormuz being more complicated than previously expected, clouding the outlook for the rate hike path for the Fed. Let's bring now for further on commodities, Sabrin Chowdhury, who's a head of commodities analysis at BMI. Sabrin, really great to have you with us. So let's start off with copper. Of course, there's so much pent-up expectation in terms of what these tariffs will do. How do you make of the structural fundamentals when it comes to copper at the moment?
The copper market is actually pretty well supplied compared to past years and compared to what will happen in the coming years. So there has been very healthy production from China in terms of refined copper. Chile is doing well as well. And the demand sector outside of the green revolution and the tech revolution remains weak. So I'm pointing to the infrastructure and real estate issues in mainland China, which is a major consumer of copper globally. So in terms of physical fundamentals, the market is still better supplied than before and where it will be in the future. But at the same time, the sentiment towards copper is extremely strong. Now, as you mentioned, obviously there is the strong demand that's coming from the AI sector. Copper is a significant metal used in physical AI infrastructure. There is the green energy demand as well. But at the same time, recently we've had news of the DRC banning exports of copper concentrates, which will definitely impact sentiment more than the physical markets. The DRC, despite being a major producer of copper, most of its copper is exported after being refined. So the ban doesn't really hold a material impact on physical supply.
How much of the drive in terms of its role in the green transition, AI infrastructure is still at play here, given a lot of the volatility that we've seen over AI projections at the moment?
Despite the current volatility, producers have been exporting pretty high amounts. A lot of the AI industry has already stocked up on copper. So prices have already been driven in the last couple of months. If you look at metal prices, copper is one of the metals that has benefited significantly and sustainably in the last couple of months. They have been on a consistent uptrend despite risks in the US and Iran, between the US and Iran, geopolitical risk globally, risks towards a global recession. So copper has benefited despite all of that, and that is really due to the AI and AI demand as well as green demand.
When it comes to oil, we've had so much to and fro in the price action, right? Where to from here in terms of how sustained either gains or losses would be, just given how much uncertainty there still is over the Strait of Hormuz and the broader implications of this conflict?
So oil prices are extremely volatile at the moment. Prices have averaged around $87 a barrel in the year to date. At BMI, we forecast prices to come in at an average of $83 a barrel for the whole of this year. Now, this is contingent on a number of factors. So we hold the view that this conflict will be resolved with a preliminary deal by the end of Q3. So by the end of September, there will be a preliminary deal. So the probability of that is the highest. So if that happens, then we do expect Hormuz normalization of at least 30 vessels through the Strait of Hormuz in about 6 to 12 weeks from the announcement of a deal. Now, there are extremely high risks of an escalation at this point as well, so it is extremely uncertain. We see escalation risks to be 35% probability at the moment. In case of escalation, prices would go beyond $100 a barrel. And obviously, there would be no normalization in the Strait of Hormuz because that would take 6 to 12 weeks after any deal.
And of course, this has flow-on effects when it comes to gold as well, right? Particularly the higher oil prices, the expectations from the Fed. It's been an interesting week for gold. So much still hinges on what happens to energy supply, right? And how that feeds through to what the Fed might do.
Yes, exactly. So gold has always benefited from geopolitical tensions, geopolitical risks. The world goes into risk mode, gold goes up. But this time, gold has not been able to benefit from that. And that is really because of higher oil prices as a result of the conflict that has resulted in a lot of hawkish signaling from the U.S. Fed. Now, gold being a non-yielding asset would obviously suffer if interest rates went up. So gold has been under significant pressure. The U.S. dollar has also been strong this year. We do expect further upside risks to the U.S. dollar as well, to the detriment of gold. So gold has been capped below a strong overhead resistance of $4,300 an ounce, with a very strong support level still around $4,000 an ounce. Central bank purchases of gold remain very strong, which is going to be a main driver of upside, if any, for gold in the coming weeks.
Sabrin Chowdhury, really great to have you with us, who's a head of commodities analysis at BMI. More ahead here in the Asia Trade. This is Bloomberg.
Singapore lender OCBC's second quarter profit topped estimates, helped by strong insurance and wealth management fees. The bank's own net income rise 22% to $1.7 billion and reaffirmed plans to complete its capital return program this year. UOB also reported earnings in line with expectations. Profit rose 10% to $1.15 billion, underpinned by wealth management fees that helped offset declines in lending income. Heidi.
Yeah, DBS CEO Shery says the bank's biggest challenges over the next year will be geopolitical uncertainty and the rapid evolution of AI. Tan Su Shan spoke with Bloomberg's Haslinda Arman about how the company is optimizing its use of AI.
So we've always said our total spend on tech will be around circa 10% of our total revenue. Honestly, that's been pretty stable and pretty flat. The irony, and I call it the paradox of token spend, is the more tokens you consume, the lower the cost. And we're seeing that tip now. And
do you expect the
we're
cost
doubling
to...
our token consumption, and we're starting to lower our costs because of the cache, the memory, the optimization, the use of SLMs, etc. Our people are getting a lot smarter on how to optimize. So that's good.
And when it comes to models, I guess the big debate is Western models versus the Chinese models, which are 80% cheaper, some say. How do you take that into consideration?
We've always been open around not being too wedded to anyone. I think we have an open architecture. That means we're not overtly reliant on any one provider, whether it's an SLM or LLM or an AI harness builder, whatever. The key is to see who's good at what. Do proofs of concepts. We do POCs with everyone, really. And we figure out who's good. And then you figure out for yourself what is sovereign to you. What code do you want to own yourself? What sovereign code, what sovereign model, what sovereign AI harness you want for yourself and what you want to use as third party. So all this work is being done right now.
There are institutions out there which have said no to Chinese models because of the risk involved. Does that keep you up at night?
It's on whoever uses them to have your code, to put the right guardrails out. And we've got all our guardrails. And as I said, we're creating an AI harness, an AI control plane, so that we have the observability, accountability, and we have to patch. It's upon us right now to do that and do the right thing by our customers. So we're all over this, the cybersecurity and the use of AI to counter AI, top of mind.
3 to 5 years down the road, how do you see AI, I guess, reshaping DBS?
I think it will fundamentally change the way we work, right? And it means that workflows and work processes that we're used to in a vertical way will become more horizontal. It means that there will be things that, as an organization, you'll have to own. That's what I meant by sovereign code or owning your own code. There'll be things that you can buy, it's faster and easier, and that's fine. And things you own and you build. But what is important? What is the moat? What are your moats to keep you ahead? Because tech in itself is not a differentiator. Your own differentiation is, number one, your customer data, how well you use it. Number two, your culture, whether do you have a culture of innovation? Are you fast? Are you nimble? Number three, trust. That money can't buy. But your customer trust in you is sacrosanct. And how do you protect that? So for us, it's all about making sure our data works end to end. You need to have ownership end to end from the moment the data is born to the day it's expelled from your system. Who owns it? How do you keep it safe? And how do you use it in a way that's explainable and useful to your customer? And then your culture of innovation, your people. People are telling me, the level 1 production engineering work is gone. So I'm now learning domain knowledge, whether it's wealth tech, trading tech, algo trading, whatever it is. They're learning that domain knowledge and they're upskilling to become a level 2 builder, level 2 production engineer. That means you become a higher productivity, higher order work. And that's what we're hoping, that the AI will enable the human to take on higher order work. There will come a time where customers might have their own agents interact with your agents, right? But if you're lucky and your agents are good and trusted, the customer might use your agent, right? So and then it's how you create your agent control plane, how you create your agent harness to be safe, to be relevant, and to have end-to-end accountability, to be grounded in governance and controls and procedures, and to be grounded in great data and great UX so that the customers go, I like your agent, I'm going to use it for a long time. That's when you have sticky relationships.
DBS Group CEO Tansu Shan speaking with Bloomberg's Hasinda Ami. And of course, for all of these banks, the yield landscape is so important today. Outperforming the markets right now is the Topix Banks Index, as well as JGB yields have continued to rise. We're talking about the 2-year yield, the 10-year yield now holding at that 280 level. This, of course, as we saw that JGB's rally in the previous session as well, we had a solid 30-year auction. But of course, here in Japan, BOJ hike risks, fiscal supply risks also continue. We're also coming off the back of what's happening in the U.S. with the Treasury side of things, with yields moving higher across the curve, rate hike bets also increasing. Really across the world, the 10-year yield also around that 5%, given that we have seen that rate repricing on higher oil prices, Haidi, and of course, long duration AI valuations being repriced. Really anything to do with housing leveraged equities is all under scrutiny, given, of course, multi-year highs when it comes to these yield levels. In China, we'll be headed towards more reaction from what we're seeing in the semiconductor space as well, with Capricorn falling in the previous session.
Yeah, that DeepSeek story will be interesting in China, particularly when it comes to not just the resumption of the $8 billion funding round, I should say, with Monolith in the running there. So we'll be looking at investor interest for that. But also, I'm quite intrigued by the price hike. It kind of is looking like it could be an inflection point from some of these broader China AI models, given that so much of the reliance has been on economic competitiveness, performance for a fraction of the cost. So this potentially is a bit of an inflection point on the assumptions made about Chinese AI as well. So that lifting of prices on watch. The China Show is next. This is Bloomberg.